You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody, that music means it's time once again for the Advisor's Option, the program for you, the busy advisor, asset manager out there who's thinking, I really want to try those options things, but maybe I'm not sure how to proceed. Maybe you're getting some client demand and you want to take some next steps, but it's a tricky process. We understand. We got you covered here on the Advisor's Option, as well as for all of you out there, maybe a lot of you looking for an advisor. You want to know kind of what skill sets they bring to the table from an options perspective. We got you guys covered as well. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever exciting Options Insider Radio Network. You guys know the drill by now. Of course, we have the deep dive. If you want to go all the shows, the archives, all that good stuff, the app or indeed our website, the best places to go. If you want to just subscribe at your leisure, let it be delivered to your device when the new shows are available. Then, of course, your Pocket Cast, your iTunes, all that good stuff will get the job done for you. And last but not least, we also have stuff going on here in the show chat. There we go. Get all that sorted out. And last but not least, of course, you can always, usually, sometimes we'll surprise you and we'll flip the show live. And we're doing that just now. So you could join us there via the Mixler. If you're subscribed, you get a notification. If you're following us on Mixer, you get a notification when we go live. We like to put these little fun surprises out there for you throughout the middle of the week. So it's not just option block and vol views and Twyfo. You get some other fun surprises throughout the week too. And of course, however you listen after the fact, via the app, via the website, however you get it, make sure you send us those questions, those comments. We do like to hear from you guys. I know we did a big Q&A episode a while ago. That got us through the mailbag, but guess what? The mailbag's full again, so maybe we need to do another one of those one of these days. And joining me to help me just fight through the morass of your mail and talk about some interesting options topics are my usual cohorts, my partners in crime. Starting off, let's go all the way out to the far reaches of New Hampshire, where we are joined by Matt Ambertson from Options Research and Technology Services, a.k.a. ORATS. Matt, welcome back to the show.
Yeah, Mark, it's great to be back. It's beautiful out here in New Hampshire. Hope you're having a good summer, and there's a lot going on out there in the options world, so looking forward to getting to the show. Yeah, a lot to parse. I'm looking forward to do it, too. Before we do that, we're going to go a little bit farther south of you and a little bit farther east, all the way out to the scenic island of Puerto Rico, where we are joined by Chris Hausman, the Director of Risk Management and Chief Technical Strategist. There's a lot to do over there at Swan Global Investments. Chris, welcome back to the show. Unfortunately, we have an ocean separating us this time. Last time we did the show, you're right next to me here in the studio. It was fun, but c'est la vie. We'll make do. How are things in Puerto Rico these days, sir?
Well, things are pretty good. It's good to be back on, and yeah, I did have a good time doing the show from the studio, so hopefully we can do that again down the road here.
Yeah, you didn't get a chance to really sample our full adult beverage menu here for after the show, the after hours after the show. Next time you come to town, we'll do all that fun stuff. All right, we got a lot to get to. Let's get rolling. Without further ado, let's kick things off with our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody. Welcome to Options 101. This is, of course, a portion of the show where we break down some basic options technique or strategy, explain to you kind of what it is and maybe how you could utilize. And maybe today's title is a little bit misleading. I would probably put this one more in like maybe an Options 201, after you've taken the introductory course, which is pretty much all of the archives of this fine program. Then you kind of get to a topic like this, which is usually a little bit more challenging for people. Usually where the rubber meets the road for some more sophisticated options traders. Yes, we're talking about calendar spreads and all things associated therein. You got the straight up horizontals, diagonals, that sort of thing. We'll start off with a straight up calendar spread. For the purposes of this kind of conversation, we'll try to keep things simple. We can always branch off into other directions, but we'll keep things simple. Your typical calendar spread, most people are familiar with verticals, which is, of course, let's say a typical call vertical. You're going to buy an at-the-money call, and you're going to sell it farther out of the money call in the same month. So XYZ is trading 50, you buy the 50, 55 call vertical. Pretty straightforward. Most people have a handle on that. Calendars kind of go in the opposite way. So if XYZ is at 50, instead of going up, you're going to go out on that expiration cycle. So maybe you'll buy a front month expiring in 30 days, 50 call, or excuse me, in this case, you're going to buy the calendar spread, so we're going to do it the opposite way. You're going to buy, let's say, a 3-month out, 50 call in XYZ, and then turn around. Usually, for most people, the way they do it, at least definitely to start, is they keep it a straight up horizontal calendar spread, which is they're going to do the same strike in both months. So they're going to buy, let's say, the 50 call in 3 months out, expiring in 90 days, sell the 50 call expiring in 1 month, roughly 30 days. And so there's a lot you can see just unpacking that mentally, kind of what that position may look like, what it might do, what are some of the values therein. Obviously, it's sometimes counterintuitive to a lot of people when they see that at first. They're looking at it saying, wait a minute, you have a long and a short on the same strike. There's some time separating them. But what the heck is this thing? It is kind of a weird spread. So you're going to have some, remember we talked about the Greeks before on this show. This spread's going to play the Greeks a little bit, which is kind of the fun. Also a little bit of the challenge, of course. The farther out you go in that chain, the less you have to worry about theta, the more exposure you're going to get to things like Vega. So volatility becomes important. You want to look at it when you're doing these types of spreads. You want to look at how the term structure of volatility is shaping up, because that's going to be a key driver for this. You're long a farther off one, you're short a nearer term one, so you know the nearer term contract is going to decay more. That's where you get to your theta, and that decay differential is going to be a big part of how that spread performs. Also gamma. Gamma is going to be the other side of the coin. Whenever you have theta, you also have gamma. They go kind of hand in hand, and they're different sides of the same coin. When you have a lot of theta you're collecting on a short contract, that means you're also short a lot of gamma. Remember, a near-term contract's going to have more gamma than a longer term. So that means a spread like this can be a little bit dangerous if the market is whipsawing all over the place, because you got a lot of that short gamma, which could back to bite you. So it's in some ways, calendars, Matt and Chris, are really somewhat counterintuitive to a newcomer to the space. You know, you're long Vega, but you're short gamma on this kind of you're collecting this theta. There's all these weird kind of stuff going on. Maybe Matt, will start with you, because you obviously are out there at ORATS. That's kind of what you guys do. You guys piece together and analyze and study various trades for efficacy and how they can be set up. Like I mentioned, this is more of kind of a 201 kind of strategy. So I'd imagine people are maybe coming to you guys a little bit later. But what are your thoughts maybe in general? We'll start there on calendars, and maybe your thoughts on their efficacy and some use cases you like to see, and maybe some strategies you like to use when you're trading calendars there, Matt.
Yeah, calendars are a little bit difficult to visualize, but the way I like to think of it is if you're buying a calendar, you don't want much movement because you're short that kind of front month potentially that has gamma in it. So that's how I think about it. And it's interesting. We did a back test. What I like to do is test a strategy and see which months, which years it does well. So I just ran one on the SPY, typical calendar, long the 3 month, short the 1 month, maybe at or just out of the money calls. And what you see is you're going to lose money when the market moves a lot. So 2008, you lost some money on the calendars. You made the most 2015. In 2015, the market kind of stayed in a range, whereas in the last few years, we've seen the market go up pretty significantly. Recently, the market's been up quite a bit. So, for example, I think it's good just to visualize what the actual trade that you would have on in this back test. So back in May, we put on the SPY was 272. We put on the 273 calendar. Now the SPY is much higher, 278, and you're losing money on that because it's moved so much. So the way I think about it is, when you put on a calendar, you don't want the stock to move too much, and it's a little bit difficult of a trade because you still want the volatility to hold. So I've always found it a bit of a difficult trade. You want to do it when maybe the vol's low, and because it's a long Vega trade. So that's the way I think about it, Mark.
Yeah, it is challenging, just trying to describe the optimal setup for a calendar, the optimal use case, because you're right, you have these kind of two contrasting sides. You have the near-term portion where you kind of want nothing to happen. You want the market to just sit there and be very calm and very tranquil, and then maybe once that leg expires, maybe put another one, or maybe you let it go. Now some people like to do calendars that way, where now they kind of just have a maybe not quite a free, but a lower cost call. Now they want the market to rip. Now they want it to take off. So it's kind of almost the tale of two different markets within the same trade sometimes, which is another reason why this one is so just confusing. Chris, I know you guys at Swan are mostly in the overlay game these days, but still, if you think about it, a lot of what you guys are doing is pretty much a long, crazy long diagonals at the end of the day. But what are your thoughts, maybe some general thoughts you have for our listeners on just calendars? I know they can be intimidating to a lot of people when they first approach them. What are your thoughts there?
Well, they're pretty versatile tools, and I think a lot of people who are in the buy-ride game or the overriders who are selling the upside calls are actually trading a lot of calendars when they're systematically rolling out of diagonals and not really realizing what they're trading, right? There's a different type of MO or objective. I approach calendars a little differently. I think a lot of people, they can be finicky and like, Matt said previously. So And you also mentioned that you're trading term structure. So you have to be careful, because when you're trading term structure, a lot of people make the mistake of comparing absolute volatility in one month with absolute volatility in another month. And the reality is there's a forward volatility. Okay. So there's actually a volatility in between months. So it's very similar to the term structure of interest rates, which a lot of people are familiar with. So you have to assess what that forward volatility is. Because there's really two types of Vega out there. There's raw Vega, which we're all familiar with, but there's also what's called the modified Vega. And that modified Vega takes into account that you're dealing with two different types of expirations, and it kind of normalizes that raw Vega. So you have to be careful about making sure that forward vol or that calendar volatility is in line with what's surrounding, right? We're getting option pricing is all about relativity. So, if that's kind of 301 type stuff, but I think if there's other strategies that you can do that will mimic similar risk return profiles, like butterflies. If you don't want to deal with term structure risk, and you're trying to get that same type of, hey, I want the stock to sit, I want some premium expansion, I think, to begin with, you may want to look at butterflies as opposed to calendars.
I like it. I just got through saying how we're going to scare people, and then Chris dives into raw versus modified Vega. I like it. Good stuff. Just that term alone, raw Vega, is probably terrifying to a lot of people. Oh, I have raw Vega. Uh-oh. I need to maybe cook this a little bit. Let it steep. Let it saute a little bit. Sauteed Vega. That also sounds. Maybe that's a good dish for our future financial cafe. But that's a digression here. Of course, yeah, as Chris and Matt mentioned, there are a lot of nuances to calendar spread, which is one of the reasons why we kind of delayed this topic for a little bit. We're going to be doing an overview today. Maybe we'll do a deeper dive in some specifics after we get some of your feedback, some of your questions on later shows. But in general, Chris mentioned one way you can kind of do an end run around it, which is maybe you said you want to look at some of the flies. Another way to maybe think of this type of spread, if you want to take it as the most base concepts, is if you're looking at this spread, maybe you're thinking of it as a way to potentially finance a call. And if you're doing a call, you could do these calendars in any way. Let's just keep it calls, a long call calendar for the sake of simplicity. If you're looking at it that way, then of course maybe you have a longer term bullish outlook on an underlying. Near term, you kind of think it's going to kind of stay where it is pretty much, and you want a way to put on a call longer term. Maybe you want a way to finance that in the interim. A calendar could be an interesting way to do that, because remember, you have that long call that you're buying, which is kind of where your net outlook, your net economic interest really lies. And you have the narrow term call that you're selling mostly as a financing vehicle. And so you think about that. If you have 30 days where you're short the option and 90 days you have the long option, in that 30-day interim while that short call is active, you kind of want the market not to do much. So let's say, in the sake of this example, we're talking about the 50s. You're along the 50 calendar in a particular XYZ, everyone's favorite name. In the first 30 days, you kind of want the market to do nothing. If those calls go out right at 50, you're perfect. You're good. The options expire worthless. You got the maximum amount of decay out of that option. Now, guess what? All you have left on that spread is pretty much a long call. That's kind of the most basic position on the planet. So if you see the calendar like that and two kind of very basic components, it may make it easier to wrap your head around. Now, there's other ways you could jazz it up, make it more sophisticated, make it actually pay off. You could, instead of letting, once that first month call expires, instead of just keeping that long call position, you could say, yeah, I want to close it out. Or perhaps you want to instead continue financing it. So you write another call. So you have 1 month call versus now a 2 month call, because 1 month has gone away, has expired. So you can keep that process going. And then once again, you're back to that same position of you want the market to kind of sit there until that short call expires. And then all of a sudden you have a long call that's worth less because it's decayed a bit, but also you paid for most of it now with these short positions. So that's an easy, kind of more intuitive way to think about it. It's a way to finance a longer term call. Now, again, as Matt and Chris kind of outlined, there are dangers with that. If the market starts whipsawing around, you're short a narrow term contract, which has more gamma. Delta is going to change quite a bit more. And as a result, you could find yourself in some, particularly if you're a novice, in some hairy situations that you may not be comfortable with. Your broker could be calling you up saying, hey, what's going on with the spread? You have these crazy, or maybe not even see it as a spread if they're not too sophisticated of a broker, and so this is crazy short leg, and start asking you questions about that. But in general, yeah, that's a good way to look at it in terms of that spread. Very basic, effectively 2 calls for the sake of our position, and you're using one to finance the other. Now, of course, Chris kind of alluded to it already, but there are variations, there are flavors on it. I just kind of broke one down, which is kind of doing consecutive short-term contracts to finance the longer term ones. So you're kind of keeping that spread alive for the length of that other option you have on. Another way to do it is, instead of going straight up horizontal, you get a little funky. You go diagonal. So maybe you buy, in our sake of our example, you buy the 3-month XYZ 50 call, then you turn around in the front month and you sell the XYZ 60 call. So now you're getting crazy. Now you got a time spread, you got a bit of a vertical going on as well. It's kind of crazy town there, Matt. Why, in your estimation, as the man who's run, I think, what's a conservative estimate, 8 bazillion back tests over there at ORATS, why do you see clients, or maybe why, in your estimation, do people maybe sometimes change to the diagonal rather than just a straight up plain old horizontal calendar?
Yeah, well, a diagonal gives you delta. So whereas, if you're doing a horizontal or the same strike, your deltas are going to be generally pretty similar. But if you're doing a diagonal, you're taking some delta or directional feel for the stock. As a matter of fact, when I finished my commentary right now, maybe I'll run a back test that continuously sells maybe the 3-month and then closes it out when it gets to a month, and then keeps selling maybe a month. So what we'll do is we'll check out, and that's a little bit of a complex back test, but we could see the strategy that you were talking about before, where when a short option rolls off, you sell another one and another one, and while you still have that kind of protection, so you're collecting all that theta, and you still have the units, or you still have a call out there. So let's just take 2 market scenarios. If the market goes up, then you will have, and you keep selling the at the money, and your original long goes more in the money, so that'll be kind of a diagonal. So you'll have a long bias there. So that'll be interesting to see. And if the market goes down, you will be selling the at the money, so you'll be selling lower strikes because the original long strike that you put on will be a higher strike since the market's gone down. So let me do this, Mark. I'll hop off and then run those real quick and let you know how they work out.
Great. Put that out and then maybe tweet them out, and we could share them, obviously, with our audience. The listeners can get them. We'll put them in the show notes on the website, and also even some of our live listeners can get the benefit of your myriad back tests. How's that sound?
Yeah, it only takes a few minutes, so I might even have them by halfway through the show.
There we go. I love it. See, the magic of technology. Get those CPU cycles in your back pocket, listeners. You can do anything these days, even very complicated back tests like this. So, Chris, like I mentioned before, you're doing the overlays over there at the DRS, so you're effectively buying longer-term puts and then turning around and then selling nearer-term calls. And also, you also have that nearer-term put leg as well. So you're kind of doing a combo long calendar there with some extra kickers. What are your thoughts on maybe the nuances between trade-up calendars, your horizontals versus diagonals, when you would choose to utilize some, maybe some pros and cons of each? What are your thoughts there?
Yeah, a couple of things. First of all, trading calendars can be finicky, like we already said. So if you're doing 1-year volatility or 2-year volatility versus 30-day and 60-day volatility, that's not necessarily a calendar, because, again, the Vegas are going to act very, very differently. So I think one advice, if you're going to be trading calendars, is kind of keep them tight to the vest, meaning, make sure they're only like 1 month, 2 months, maybe 3 months apart. Once you start going 1 year, 2 years apart, then it's no longer really a calendar. Again, because volatility is going to act very, very differently from the short space versus the longer dated space. I think one effective way of using calendars is a combination of things. So when you see term structure being flat or term structure inverting, in other words, going into a backwardation situation, and you think that the underlying or the index is going to rally, out of the money call calendars have been pretty effective during those types of environments. So again, that's a combination of seeing, a certain setup with term structure. You are taking some deltas because you're doing out of the money calls, which, again, that's going to require some, additional analysis on, when you think a market's going to bounce.
That's all good commentary. You know, of course, I like Matt's analogy as well, that sometimes maybe you have more of a rolling diagonal, where you maybe put on the one longer term contract, the call, and then the market starts moving around. So you start legging into what is effectively a calendar with a longer, higher up leg on the near term, or maybe it drops. You do the opposite, longer. Now your call is out of the money longer term, and you have in the money, at the money call, you're writing down below. A lot of different ways that these spreads can play out. Sometimes not always at the outset. Maybe you start trading around. Next thing you know, you've legged into a calendar, a diagonal there, which is interesting in and of itself. These things play out a lot of different ways. You know, in general, I know you guys, we tend to really avoid the the expiration graph type of analysis when you're looking at and explaining basic positions. But in general, if you're looking at your typical basic straight up horizontal calendar, let's say you paid $1 for that spread, the XYZ 53-month calendar, call calendar. That should, in a lot of scenarios, there are maybe some aberrant ones, in a lot of scenarios, that should pretty much be your max exposure to that spread, that $1. So that should be a little bit comforting, even though things can get a little crazy when things get rocking and rolling. In general, that should be the where you're usually exposed. Remember, you have one contract kind of offsetting the other. When things get a little wonky, as Chris was mentioning, when things get maybe backward and the front portion of the curve is going crazy, and that front portion is going crazy, that's when things can get a little bit hairy for people who are not used to dealing with and managing and adjusting collars. But in general, that should be. And of course, as you mentioned, the outline before, if you're looking at it the way it is, if you're just looking at the finance, in this case, maybe a longer term call, the potential gain you could have on this trade there's no limit to it. You know, the call could take off and be off to the races, and it could look very well. So in that case, you know, from looking at that from the straight up kind of P&L graph, it can be an attractive trade from that perspective as well. But again, I would encourage you to have a very strong understanding of all of the different nuances therein in terms of term structure. Like Chris was mentioning before, that if that terminology is unfamiliar to you, maybe you want to stay away from collars. In addition, all the Greeks you talked about, delta, gamma, theta, vega, you should have a good understanding of what they all are, how they all work, and more importantly, how they evolve as you move back and forth across the term structure. So a lot of things to consider, a lot of things you should be armed with before you're really diving into the world of calendars. Again, as you mentioned, this is really kind of 201, and maybe as you start getting the different flavors, even 301 kind of stuff for options. So if you're brand new, like a lot of you are, I know, listening to this show, you kind of just want to write a covered call for your client, or maybe just buy a put for your client, it's okay. We'll get you there. Just take some time. You don't need to go down the deep waters, but it's something to keep in mind as you're getting a little bit more sophisticated in the space. Speaking of things to keep in mind, I've been keeping in mind Matt's back test, and guess what? The man's quick over there at Oratz. He's already got the answers. Matt, what do you have in store for us, sir?
So unfortunately, our brilliant strategy is not looking that good when we're, buying a farther out of the money call.
In the cold light of day, they all just fall apart, don't they, sir?
Yeah. Especially if the market's ripping up, you're continuing to sell and at the money. So that's the problem is in these markets that are just one directional and going pretty fast. You keep selling that call, and the long call is not going to keep up with it. So back to the drawing board, Mark, on our calendar.
There we go. Brilliant strategy we had that now perhaps not looking so brilliant in the cold light of day. So interesting stuff, and I think we could do a lot more on calendars. But I don't want to overwhelm the audience right now. I think let's just plant the seed, let them look at it, let them start looking at it from a more basic, just financing that longer term call, or maybe as a put if you want to do it that way, and then start playing with the variations and the flavors there. I kind of wanted to just pique your curiosity, whet your appetite there for some of the fun things therein. So let's go back on the horn maybe one last time. Give us everyone's maybe final thoughts, maybe some interesting takeaways you have when it comes to calendars, diagonals, all the different flavors they're in. Matt, since you just ran all the data, maybe we'll start with you. Any final takeaways you want to leave with our listeners on this topic?
Yeah, I think you really need to know and really need to back test and understand the strategy. I do remember from the floor days, a gentleman that started on the SIBO back in the 90s, the same day as I did, as a matter of fact, he would always price things in his head by the calendar. And that's how he would trade. And he did real well for himself. So, as with almost any trade, know what you're doing when you put the trade on. know when it performs the best. As Chris says, there are times when this type of calendar will work in your favor, and sometimes when it won't work in your favor. So that's what your job is as a trader, is to know what these strategies are going to do under certain volatility environments and stock movements. Mark.
Yeah, it's there's a lot of nuances therein to sink our teeth. I see some people are posting in our chat their own nuances. We'll get to those in a little bit. But yeah, these are highly nuanced trades is probably the best way to describe them. Chris, any final thoughts on calendars and diagonals before we move on to the buzz, sir?
Yeah, I mean, calendars can be very versatile, but I think if you're starting off, you're completely brand new to options, I would try to get a better handle of butterflies and how they work. And then kind of graduate up to calendars, because then you're adding what we said already is that term structure element. So you don't have to deal with term structure, but with butterflies, there are no net short units. It's limited risk, limited reward. And I think something that's a lot easier to understand, especially if you're just starting out.
Yeah, I can get behind that synopsis there as well. We got to keep on rolling, listeners. It's time for us to get on into the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to the buzz portion of the show where we break down some of the interesting stuff that's going on in the world of options that pertains to you guys. The financial advisors, the active managers, who don't really have time to pay attention to this space all the time. So we kind of do it for you. Just kick things off as we like to do each month, kind of breaking down what happened last month in the world of options. And May, if you're paying attention to the markets, was a pretty decent month. It's been a good year. 2018, in many ways, kind of the polar opposite of 2017. This time in 2017, volume was in the toilet, volatility was in the toilet. And granted, we're getting back that way from a vol perspective, but volume, not so much. Volume still very much strong here in 2018. In fact, in May, the numbers coming out of our friends, the OCC, of course, the parent company of our friends at OIC on this program here, looking at a really good, another good month. Overall volume at OCC up 8% from May of 2017. We'll just drill down a little bit. OCC clears a lot of stuff. We're very much interested in the listed options side. Options overall was about volume, about 404 million contracts in May. That's up 10% from May 2017. The equity options, 366 million contracts, a 12% increase from May of last year. That, if you drill down that rabbit hole a little bit farther, cleared ETF volumes make up about 151 million of that. That's a 12% increase as well. Index options, kind of the lone, one of the few dark spots there, down about 4%, 37.5 million contracts in May. And futures, which at OCC, they don't clear a lot of futures. They pretty much clear VIX futures and the SIBO Bitcoin futures. That's kind of about it. So you think with the addition of a new product, things would be up, but actually futures are down 44% from May of last year. A lot of that probably having to do with the big debacle of the inverse vol ETPs from around February earlier in the year. A lot of those were using a lot of futures to unwind and unbalance and driving a lot of futures volume as a result. And now the SVXY has been changed and XIV is kind of off the board. That doesn't leave a lot as well. Not doesn't leave a lot. It doesn't leave as many players out there to sling the futures. As a result, volume down somewhat precipitously out there over there. So probably one of the few downsides. Also worth noting, our friends at OIC, Eric, once again, traveling, couldn't join us on the show today from the advisor team at OCC and OIC. But the OIC likes to put together a lot of data, and they have a new study. And we talk mostly, our focus here in the domestic U.S., but guess what? Options are everywhere. And the demand for options is everywhere, including, we shouldn't ignore our friends across the pond in Europe as well. And OIC has not. They have a new study coming out. They kind of took the pulse of the European options market, particularly a lot of the fund managers and professional investors out there. And they found that, guess what? They like options too, which is a good thing. So if you're an advisor overseas, maybe, or maybe you're looking at some clients from overseas here, it's good to know that the demand is strong there as well. European options users like to focus on income generation, capital appreciation, and vol strategies. So effectively, they like same things most people like to do here in the States. They found that European, investors, trading funds, that sort of thing, account for about 9% of overall U.S. options volume, and that their magnitude of their equity holdings in the U.S. has increased 52%, so over half, since 2013 to around $461 billion. That's the underlying equity holding. So clearly, they have a lot of stake in the U.S. markets, and they're looking to do options trades around those positions. Hedge funds were the biggest category, European users counting for just over half of the European order flow. Then private wealth management, about 21%, prop firms, 12%, and then investment managers, 8% over there. So interesting findings out of our friends over there at the OIC, always coming with data. Matt or Chris, any thoughts here on both of these kind of results? First off, the numbers for May, probably not really a surprise that May was a strong options month. A little bit of surprise on the volatility futures over there, that they're falling off so precipitously. So maybe some interest there, as well as, of course, any thoughts on our counterparts over there. And maybe Chris, we'll start with you. Maybe any thoughts, since there is so much demand from funds and advisors and investment managers in Europe, are we going to see maybe a 10th box in Europe anytime soon?
Well, I certainly hope so. But getting back to the data that the OCC provided here, I think it's good news to finally read that equity option volume is increasing, because there's been this theme over the last year, and Matt's at the forefront of this about liquidity. Now, unfortunately, my gut feeling is telling me, and I have not looked at the specific data, but I'm wondering how much of this option increased volume on the single stock space is attributable to just a few stocks. I mean, we know the FANGs get a lot of action, but it's hopefully this is spread out, although I kind of doubt it. But at least maybe this is the beginning of a pause where, there was this big sucking sound where all this single stock option volume was going to index away from the equities, and maybe that's paused for a little bit, and maybe people are starting to realize, that they can use all these different strategies on single stocks, as opposed to just the index and the ETF products that have gained all this volume over the last few years. So yeah, as far as overseas, we definitely have our eye on that and trying to get geared up. It's again, it goes back to education. Not only do you have to teach people about options and strategies and portfolio management, but there's a little thing in between our country and Europe called the Atlantic Ocean, and we have to bridge that as well. And it's just a different environment and a different methodology when you're dealing with different backgrounds and different environments. Of
course, when you're talking about different environments, the regulatory scene comes into pass as well. In fact, one of the major obstacles that they all cited for using more U.S. options was the different regulatory environments, what's going on in Europe right now with MiFID and all the MIR and all that stuff, in the U.S. here with Dodd-Frank. It's a very fluid environment, shall we say. So some of that hampering perhaps more additional growth. Matt, any thoughts on this? And do you have a lot of European users over there at ORAS these days?
Yes, we do have clients in the EU, and we just got one in a tiny island, Malta. So they're definitely back testing and putting on strategies, and heavy users of the back testing. And so there's definitely interest in the EU, and just to expand on that, we do have a few in Asia, but I would say and Canada, but Spain, London, and of course, United States are our biggest source of clients. But Chris mentioned the liquidity. I mean, we are starting to see some signs of life, but I think until some more structural changes have been made by the exchanges, there's still going to be some issues. Definitely where Chris lives in the bigger indexes, where it's very liquid. But as you start just traveling out, 100, 200, 300 place in the liquidity, the markets get wide. And I did hear a presentation by one of the market makers, and they're echoing kind of what we've been saying, is that they don't have the incentive to make the tight market. So my hope, I've been, as we all have been, have devoted our professional lives to options, and I hope that the exchanges can realize the damage that they might be doing to the industry by not making some changes to get more liquidity in some of these smaller stocks. We have clients that need to buy right, need to that have concentrated positions that can't get a good market to even look at, and for us it's difficult to do research if we're not seeing the markets out there. So albeit there is some signs of life, but for the most part they get ignored. All these other small stocks. When we were making markets on it, you had a bunch of eyes on it. Now there aren't too many eyes on it, so I can understand why the market makers need to be wider. And then another thing that I've seen just recently is the 5-day historical volatility or realized volatility of the SPY is now down to about 5, and we haven't seen that since before the February debacle. So that's when the volatility the realized volatility starts getting that low, that will take some of this volume out. So my guess is that June is not going to be as strong as we've seen in May, Mark.
Yeah, you're right. We're starting to get back around those really, really precipitously low realized volatility levels that we saw back in 2017. Yeah, and a 5 it's getting down there. I mean, we got pretty much around to close to those levels last year, and then we'd always see a little bit of a spike. Something would get a little bit of vol going again. But you're right. That's a whole lot of nothing, which is interesting. Speaking of interest, we talked about European interest. Let's get a little bit closer to home again. We were playing around with some interesting data this week. I thought it'd be fun to share it with this audience as well. Just about what Google search data reveals in terms of overall level of interest in options and options trading and things like volatility and how that has evolved over time. Google very much a barometer for these types of things, because guess what people want to do when they want to learn about something or are interested in something? They go and they type it into Google. So it's a good way to parse that. So we've been playing around with a lot of Google Trends data of late, and some of it came top of mind. We started off with, we thought we'd go a little bit deeper down space. Let's get more specific. Let's look for something like options trading, a search term that a lot of people will look at or search for if they want to learn more about or do some options trading. So we thought we'd start there and see kind of what the interest level has been. Remember, this goes back to about 2004. This data, which is kind of the primordial ooze days of Google, also almost does predate actually the option insider by a few years. That's how far back it goes now. Here, so looking at that, it's kind of interesting and actually maybe a little bit alarming when you look at this pure data, because the chart here shows that the high point on this graph was back in 2004, January 2004. So the start of this graph, and it's kind of been a slow but steady decline. We're roughly at about half of where that high point was back in 2000. Remember, the way Google looks at these graphs is they'll mark the highest point. That'll be effectively the 100 level, the most level of interest on the graph, and then the rest will be some ratio therein. So at a 50 where we are right now is roughly half of that peak of 100. So perhaps not the strongest trend. We have seen pockets of life, pockets of interest, like in 2008 when of course, a lot of people were interested in protection, and very recently in February. But outside of that, the long-term trend hasn't been good, which is interesting when you see that data, and it kind of makes you scratch your chin, because at that same time, options volume has gone through the roof. Over that past 14 or so years, we've seen volume on exchanges and the number of listed products, everything else just exploding. So two very diametrically opposed graphs, which is a little bit interesting and a little bit odd and head scratch. So we thought maybe that's not revealing. Maybe we need to dial it back a little bit, get a little bit more generic. Let's look at the most generic term you could search for when you want to learn about options. Obviously, that's going to rope in a lot of other stuff too that isn't financial related. So it's not the most reliable thing, but still, overall, it shows you some interest. And we look at that term, that interest has remained effectively steady from 2004 till now. So things haven't really changed too much on that front. So read into that what you will. It's a very generic search term, but sometimes if you cast a wider net, you can catch more things in it. Then we went back down the rabbit hole a little bit again. Let's look at something that's near and dear to us here on this show, and indeed on the network and in all option traders. That's volatility. We were just talking about it when we were doing calendar spreads. How does that look? And if you look at that one, the high points are probably where you would think over the last 14 years, pretty much right around October of 2008. That's the high watermark, and then a very close second coming this February in terms of interest, search interest in those subjects. The rest of the time, we're pretty much right now, roughly half of what's those peaks were. So interest in volatility has kind of been steady. Has a few spikes, kind of like the VIX, kind of stays steady, and that spikes itself over time. And we went also, we got a little bit down the rabbit hole as well. We started looking at things like we were just talking about, realize historical volatility, and that one, a pale shadow. But then again, that one's kind of more down the rabbit hole. Kind of interesting, just some interesting data. Kind of very much contradictory, a lot of it, to what we've seen in the broad industry, which is kind of weird. Matt, I know you're a data guy. Maybe we'll start with you. Any thoughts on this and maybe the kind of contrasting nature of these charts and the level of interest they're showing versus the actual trading interest that we've seen on the exchanges and with the brokers?
Yeah, it was a shocking graph to see, but I started to think about it a little bit more. We've been in business since 2002, and we've had an AdWords account, so we've been following this. But I didn't graph it over this long term, and it's funny to see, when they search for volatility, it's 2008, and then again in February, this last February. So that's kind of interesting. I don't know, Mark. Here's a thought that I had. But if you remember, the kind of day traders were, in the 2000s were still around, and so it seems to me that there maybe were more individuals. I mean, I'm sure that this is more of an OCC type of research, but I've noticed bigger firms having a lot more interest lately with the increased liquidity in the indexes and such. So the profile of our clients has definitely changed since 2004 to now. We were getting a lot of smaller, well-capitalized firms back in 2004, and those have generally gone by the wayside. So I'm wondering if it has something to do with the smaller trader being pushed out a little bit, but more option trading maybe with the quants and the bigger firms. But anyway, that's a theory that I had, Mark.
That could certainly be it. I mean, because on the one hand, a guy on the quant desk isn't typing options into Google, right? He probably is a little bit more savvy than that, and so that could easily reflect a bit of a bifurcation of the option space, more institutional flow, and maybe a little bit more nebulous in terms of the retail growth, which is kind of interesting. Chris, any thoughts on this and kind of just the interesting, maybe contrasting nature of this data?
Yeah, it didn't surprise me that much, and it's along the same themes that Matt just mentioned. I think the type of person that's trading options today has shifted, because years ago they were seen as speculative instruments, almost like futures, and you had a different type of person using options in the shorter term. And so what you've had over the last 5 years or so, 5 to 10 years, along with all the education, is this tectonic shift in, hey, wait a minute, I can use options to protect my portfolio. I can use options to enhance income, and really kind of like what Matt just said, more institutionals, more advisors using these instruments, as opposed to the back in the day when, they were very, very voodoo and they were gambling instruments. So I wasn't so surprised by seeing this kind of data where options trading has kind of diminished, but options interest, and again, I don't know all the inputs into this data, but has remained roughly the same, because we see it every day. More and more people want more education. They want to be able to employ options. They want to learn more about how to insure their portfolios. They want to learn more about how to enhance income, et cetera, especially when we have such a low yield environment that we've had over the last 5 to 10 years. So yeah, I guess I wasn't, just to sum it up, I wasn't too surprised by these by the graphs that you're showing here.
All right, we got more developments I want to get to, but we want to get some listener questions too. You guys send in so many to us. Make sure we get some of your love as well. So without further ado, let's get into our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com. Emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, welcome to the office hours. They are now open. The sign says open on the door. Really quick, one last quick thing on the Google Trends data. This is maybe a fun one for you guys to play along with as well. We asked our audience this week and last week, Google breaks down interest by different subregions, aka states. Which region do you think Google ranks as number one for overall options interest? Remember, this is not by the volume of interest and queries by area, it's more by per capita. So if you have 1,000 in each state, it's going to rank the smaller states higher, more heavily than the larger state. Just bear that in mind. But we gave them 4 choices: Illinois, California, New York, or Maine. Our audience chose Illinois, 33%, just barely above New York at 32%, 23% for California, and 12% coming in for Maine. Matt, you're close to Maine, so I guess I'll let you start. I guess my criteria here. Really quickly, what are your thoughts? What do you think is the number one sub-region, aka state, for options interest in the U.S. according to Google?
Yeah, I've been to Maine, and not a lot of people are talking about options there. New York, I lived in California. I think it's between New York and Illinois. I'm going to go with Illinois. They started out in the lumber business many years ago, and there are many traders in Illinois. I'm going to say Illinois, Mark.
Chris, are you going to agree, disagree? You going to go somewhere else? What are your thoughts, sir?
I'm going to disagree. I think I'm going to go to California. They're a little bit, historically, they've always developed a little bit after the East Coast and all that, so that's what I'm going with.
Both well-reasoned arguments. Our audience also made a good choice. I think intuitively you can make a good argument for a lot of those, but actually, according to Google, that's why I gave you that caveat there at the beginning, it's actually Maine. So I think Matt, that Andrew alone accounts for about 80% of option searches in Maine. Would you say that? It sounds about right. Because, Maine, number one by capita in terms of, at least as Google ranks it, the number one sub-region when it comes to options interest in the U.S. So put that in your pipe and smoke. A lot of you guys right now, I want to make sure we get some of the live people too. We got, who is this? Got T-Mal listening live. He liked our chat earlier about calendar spreads. Let's see. He put a lot in here. He says he wanted to chime in and say we were talking about calendars versus diagonals and some of the nuances of these spreads, how to use them. He says he has this exact thing going on right now, but he's using a put diagonal with different futures as the underlying. Oh, that's an extra layer of nuance. We didn't even get to that. We didn't get to different underlyings. Same underlying, different futures. That makes another layer of abstraction. He says he's doing it on a 90-day, and he's getting kind of thrown off because the Vegas are totally different. On top of that, he has the future spread risk going on. So he's having a hard time trying to figure out what the hell is causing the changes in this P&L. Is it the future spreads? Is it the option spreads he has going on? As he terms it, complicated, and then a non-family friendly word that we shall not use here. But he says very nuanced. Holy cow! Yeah, that sounds. We didn't go that far on the show because we don't want to scare people. Maybe, I don't know, Matt. Maybe it sounds like you might have a client. He might need to back test this strategy and figure out what the hell is what's causing his P&L. Is it the futures deltas or is it the options? Do you guys do? I'm sure you guys do futures back tests as well, right, Matt?
Yeah, I feel his pain. You were in the index pits, so I never was in those pits, Mark. So the futures I didn't use them as much. But what we do is when we look at an index, we'll solve for the futures for each expiration, even if that expiration doesn't even have a futures for it. So that does confuse some of our users. But they're easier in some respects and harder in other respects. But I could feel for this person here, Mark, especially with the different futures carrying different deltas. That's what still gets me once in a while, Mark.
Yeah, that's getting pretty nuanced. I think your average broker probably won't be able to model that very well, or at least show you any sort of effective analysis or back testing thing. So maybe you want to hit up Matt at Option Rats on Twitter. Probably the best way to get a hold of him. Maybe he'll also give his email at the end of the show if you want to reach out to him, because it sounds like you may have need some back testing and some analysis, sir, to see exactly what the hell's driving your P&L. Yeah, but I'm with you. I used to be an SPX guy, so all the futures gets very nuanced. You guys start doing your rolls and everything else, and you want to just focus on the options, and the futures keep taking you away. So I feel you. We got a comment here from A. Keats, loving the show. Said, just discovered the radio show, and I am absolutely hooked. Great content. Well, thank you, A. Keats. So we always love when new people come to play and enjoy us here on the program. Clearly a person of very discerning taste over there. All right, we'll close out on this one. A little bit longer question. Chris, we'll probably have some good stuff here for you as well. Brad K wants to know. First off, says, I'm learning a lot from you guys, particularly about the value of hedging. I also took your advice and switched to an advisor who uses options much more actively. Well, there you go. We know you have a lot of advisors and asset managers listening to the show, but we know you also have a lot of people who are end users of those people. So glad to see you took our advice there, Brad K. He goes on to write, now I'm starting to spread my wings to the commodities, particularly crude oil. I want to hedge my oil exposure with WTI options. So here's a couple of questions here. Does the Swan DRS on crude use WTI or USO options? Also, I would please like to know the panel's thoughts on trading options on commodities versus equities. Any major differences I should be aware of? Thanks again, and please keep the education coming our way. Well, a lot to unpack there. Maybe we'll start with the straight up question first. Chris, he has a question about the DRS you guys have. You guys have one on crude, I think he's correct. What do you guys utilize for that?
Well, we don't have a formal offering on crude currently. It's in the research stage, but we are developing that on USO. And again, really, one of the questions is, is it going to be marketable? Is it scalable? Meaning, how's the option volume? Is there good open interest? All these factors are things that we look at. So we felt that sticking along with our thesis over the last 20 years that USO was a better underlying than WTI as far as a defined risk strategy was concerned.
You have gold, right? I know you had some commodities ones. You have gold, right, Chris?
Yeah, we definitely have gold. Again, that's in the research and development stage as well. So we hope to be rolling these out, in the next year or so. But again, you're dealing with commodities. It's not straight up equity or index like a lot of people are used to. And again, they also have their nuances, which, we have to work out through as far as regulatory issues and things like that. So there are other issues than just trading options on an underlying.
Yes, so there you go. And the second part of your question, a little bit more involved, is any major thoughts on trading options, commodities versus equities? First off, I would say, by all means, if you're looking into this, check out our TWIFO program, This Week in Futures Options. We get into all this on many, many different levels. A couple of, I think, major takeaways that if you're coming to this from primarily an equity and index option backgrounds, I'm assuming you are, most entrants to that space coming from the options world are. They're used to the typical, like we were talking about indexes, you're used to the typical index and equity option skew, which is the puts are bid, the calls are offered from a vol perspective. And the commodity realm, that is not the case. It's going to change product by product. You could have something where there's a lot of concern to the upside, so the bid's going to be to the upside from a vol skew perspective, and the puts are going to be negligible. So you're coming into this, you think you have a knowledge and understanding of how all these different strategies perform, and you do, but from a typical investment skew environment, and you need to broaden that understanding. How does a covered call perform now in an environment where the calls are ridiculously bid and the puts are offered? How do collars work in that environment? How do your typical verticals and calendars work? And when all these skews, sometimes the skew in these products could change month to month as the demand, as the interest, as the use case changes. It makes it kind of interesting. Look at gold. Gold skew is kind of all over the place. It's bid to the calls a lot. Sometimes it's plummeting and it's bid to the puts. So it's very nuanced. They're not quite as rigid in a lot of these products as the equities are and indexes are, which they're kind of always bid to the puts. Just a question of how much. You don't see that same rigidity in a lot of the commodity, which makes it interesting, I think, for me and for a lot of people, also maybe intimidating. Matt, any thoughts on nuances therein, commodity options versus typical equity index options?
Yeah, I would echo what you say. And again, what I've said many times, even including a lot of these volatility-related trading instruments, is that you really should understand what you're trading very well before you commit any large amount of capital. I am actually one that in order to learn, I will put on a very small trade. That's not really what I'm talking about. But, and one of the reasons that we haven't got more into commodities at ORATs and futures options is that, there's so much to do in the equity option space. And we have ETFs for a lot of these a lot of these commodities already, in the equity option space. So we haven't. We've been asked many times, but I would forward these comments to your other shows that you have, Mark. You've done excellent jobs in those shows. So at ORATS, we're concentrating mostly in the U.S. equity options, but we're being pulled towards the futures options more and more, Mark.
All right, listeners, that music, unfortunately, means we've come to the end of an epic show. We touched on a lot of fun stuff. Did a deep dive into calendars and diagonals. I'm sure we'll get more into that as you guys send your questions in and have your feedback on that topic. A very nuanced. You can easily spend many shows on that topic. So let us know your thoughts and your questions. Maybe not all of you are as deep down the rabbit hole as Team out there doing future spreads with the options. But hey, we welcome all comers here. Even if you have a basic question, we'll deal with that as well. Lots of good stuff talking about options interest, options data, and of course wrapping it up with some interesting conversations on commodity options and all sorts of other fun stuff here. So a lot of good stuff. We appreciate your feedback. We get a lot of it, so maybe we'll try to squeeze in more next show. We just had a really good meaty topic to sink our teeth into this episode. But before we go, let's go back around the horn. Let's start with Chris. Chris, we're just talking about your DRS on gold and the potential for a 10th box in Europe. But what is coming down the pike from you guys at Swan these days, sir?
Well, we're still doing those 10th box seminars. So again, those are a series of regional due diligence meetings. And it's a great opportunity for advisors and investors to sit down with the portfolio managers in a more intimate setting and kind of discuss the challenges in today's market and how the DRS can be a part of their investment solution. So you can get more information on that at 10thbox.com. That's 10thbox.com.
There you go, 10thbox.com. To learn more. By the way, those of you who are asking, what's about want to know about the Swan audio. Remember, we had Chris in the studio last week coming from the Swan CIO Forum. We kind of had a ton of audio to put out from the OIC conference. Pretty much all of that is out now. Hopefully you guys are enjoying it and have enjoyed our panel audio and our conversations or interviews from the conference. So now we've cleared the way to do a lot of the Swan stuff. So hopefully by the time this show hits the network, you'll also be able to enjoy the panel audio we have from the Swan at CIO Forum. If you have questions, hit us up, or indeed have to hit up the guys at Swan about some of the things they're talking about there. They could provide you with a lot more detail on that. In the meantime, of course, head on over swanglobalinvestments.com and you will learn more about that. And they have a good blog over there as well. You want to check that out. The research Mark and Micah and all those guys are doing over there. Interesting stuff. And Eric couldn't make it. Like I said, we quoted some of their studies. They have a lot of that great data and more. You can find it all. Optionseducation.org. You want to see how collars perform. Maybe you want to see different demands or different areas. You want to have a basic refresher on how these things like calendars work. They have all that there. Optionseducation.org. Check it out. A lot of good stuff. I think you're going to like it. And last but not least, Matt, we talked a lot of back testing. We had the privilege of having a back test done live on the show, which was kind of fun. Probably a first, I think, maybe for our network. But if our listeners want to do more of that kind of stuff, where should they go? What should they do?
Yeah, orats.com. A lot of back testing, a lot of data. And our newest product is implementing the back test. You could click on a back test. All of the trades, potential trades come up. You could send those to various brokers. So we're trying to help our clients implement these back tests by making it easy to get in using the scanner, and then also monitoring for exits. Very important to monitor for exits, and then also show the Greeks and where you are. So that's what we're up to at ORATS, Mark.
There you go. Check them out over there. You can even give them a follow on Twitter while you're at it. We mentioned it before, at optionrats.com. No, they're not. It's not a team of rats coming at you. It's the ORATS team coming at you with some interesting options back tests. And on behalf of Matt and Eric, who's out there hither and yon somewhere on the OIC team, and Chris, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, all the other fun stuff that you guys do, including asking great questions about calendars and everything else you guys ask about. Keep them coming, and we'll see you next time for more of the Advisor's Option.
You've been listening to The Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Global Investments. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, Swan Defined Risk Mutual Funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.